We're going to start off very light. We're going to talk about the calendar spread concept and how it is obviously notably different than a vertical spread. And we're going to talk about a subtle but important difference between what I'm going to try to teach today in terms of calendar spreads versus what you're likely to learn from a more traditional options education program about calendar spreads. And then we're going to look at how the price of a calendar spread changes over time. And I'll be bouncing back and forth between the slides right here and the Unusual Whales option profit calculator, which has a great table feature that helps me think about how these evolve over time. But I included the graph of price as well, so you can see kind of what makes calendar spreads kind of special for speculating on direction. Okay, so because I talked at length about call debit spreads, I decided for the calendar spread, we're going to look at the put side. But put call parity, call calendars are going to work the same way. There will be some nuance differences based on the usual spot price correlation with implied volatility, because traditionally when a stock price is going up, its implied volatility is like stable or going down typically, and so that's going to have a meaningful but kind of minor impact on the way a calendar works. But we're gonna talk about put calendars, so something you might use to speculate in the down direction. So a put calendar spread, specifically what we're talking about here, is a long put calendar. I'm just going to call it a put calendar because for the most part, this is the most common way that these are structured, where you are selling a shorter dated contract and buying a further dated contract. So you're long the back contract and you're short the front contract. And for everyone's reference, sometimes calendar spreads are called horizontal spreads, which makes sense if you think about time on the x axis, because you're selling a near dated contract and you're buying that further dated contract. So as time goes on, you're long the back one, but the spread, because the calendar picks the same strike on in both expiries, it's like horizontally configured compared to vertically configured for the call spreads that we talked about earlier in previous education. Now, admittedly, in your modern brokerage software, the option chain is going to unfold like vertically, right? So you still are going to kind of be vertically moving in your brokerage software, but just be aware that sometimes calendar spreads are called horizontals. Okay, so let's talk about some of the pros associated with a put calendar spread, specifically the put calendar spread that I'm going to talk about and speak on today in our lesson. So a put calendar spread is lower cost than buying a put outright. A put calendar spread is going to maintain positive gamma and positive vega, which means it's a convex structure. So the same way a long put or a long call can grow in value very rapidly, a calendar spread can do the same thing. This put calendar spread maintains convexity. And finally, the last pro, which we'll talk about much later on, but I think will intuitively just make sense to everyone, is what I call a second chance on a calendar spread. So in short, what the second chance is the fact that you're selling a near dated contract and you're buying a further dated contract. So if your thesis was incorrect about the underlying price move, you can just let that front contract expire and you still have the the back contract, the one that you bought, the long contract, you're still going to have that inventoried on your trading book, right? So you get a second chance. It's it's rare. It's not necessarily like how you want this trade to evolve, but it can work out really wonderfully depending on the expiration dates that you pick. Sometimes you just get lucky. The front contract expires and goes to option heaven for $0, and the back contract happens to be situated such that happens to still be on your book, and all of a sudden you get a big price move in your direction, and it's like you got a very inexpensive long put or long call. So you can get lucky with these as well. You get a second chance because again that horizontal nature, you have more time on one contract than the other. Now, for cons, a calendar spread is naturally going to be more complex to manage, certainly more complex to manage than a like a vertical debit spread, which you'll recall I called like a model, like kind of a model-free bet on price reaching a certain level by a certain time. You'll see when we get to the PnL graph on the put calendar spread that there are some decisions that probably need to be made. And on this intro slide right here, you can see if you look at this like the pointy tip, that pointy expiration PnL is it can be very, very high and very extreme, but it's equally extremely difficult to achieve. And so in this image right here, you can see this dotted line shows you earlier than the expiration of that front contract what the PnL might look like. There's a limited max profit associated with a calendar spread while both contracts are active. Obviously, if the front contract that you sold expires, then the back contract that you're long, that you own, can have the infinite PnL. But again, we're specifically referring to times when both contracts are active, and when both contracts are active, there is a max profit. And finally, the last con is that you can overshoot. So if you are using a calendar to speculate in a direction and the underlying moves a lot more than you had anticipated with this structure, you can overshoot. You can blow through both the strikes, and you could wind up not having a winner on your hands. The debit paid could wind up just being a loser, going to zero. You could wind up not doing as well as you would have on, say, a debit spread where everything past that short strike is max profit. Let's go ahead and talk about some calendar spread concepts here. I think this is really important, and I want this to be your number one takeaway from our little chat today, our little intro to calendar spread concepts and prices. Traditionally, everywhere that I've seen calendar spreads taught, they're classified as a neutral trade. And the reason that they are classified as a neutral trade is that the traditional calendar spread involves being active with approximately the at the money strike. So whether you're using puts or calls, the profit on a traditional calendar spread is going to come if the underlying price doesn't move around too much. Okay? And the reason for this is that the front leg is losing value faster than the back leg is losing value. So you sold the front leg and you bought the back leg, and you net paid a debit, right? And if the underlying price doesn't move in either direction too far, then that front leg, the one you're short, is going to decay at a faster rate than the back leg is going to. And this makes a traditional neutral calendar spread profitable. as time passes and volatility does not realize. Okay. Now, that being said, the way that we're going to talk about calendar spreads as a more directional trade, it's important to realize that we are not going to be executing these at the money. We're going to be executing these out of the money, below spot price in these put calendar examples. And so the PnL on these out of the money calendar spreads that we're going to talk about is going to be directional. Make no buts about it. If you are slapping on a put calendar spread and you're striking it below spot price, if the underlying price doesn't move, the debit you pay for this calendar spread is going to option heaven.
So I'm sure you'll probably get to it, but with that in mind, what are the cost slash benefit of going out of the money versus at the money?
Yeah, that's a really good question, right? So when you go out of the money, the benefit that you see has to do with a handful of things, but one of the most important things is like a larger difference in implied volatility. So the put that you're selling in this example is going to have higher implied volatility than the put that you're buying. And
so that implied volatility being higher bears credence to potentially a higher credit received.
That you read my mind, right? So you sell that, you're selling high implied volatility. You're selling high implied volatility and you're buying low implied volatility.
Makes sense.
It depends on the underlying and the difference in the expirations that you choose. A calendar spread is very customizable in that sense. But chances are it's like the difference between the two legs will depend on how far apart they are and how far out of the money you're putting the position on. And what we can do is we can actually go check. I'm sure since I started putting this put calendar like example together around lunchtime today, I'm sure prices have moved around plenty in QQQ. And so the implied volatility and the pricing of this calendar that I structured has probably changed some. And that's okay. We'll be able to go look and see how different the front leg implied volatility is versus the back leg implied volatility. Yeah. But again, we're sticking to our Buffett principle, right? We're like selling high and we're buying low. It just so happens that the same strike price has different implied volatilities over time in the what's called the term structure. And that's another reason why I love our volatility dashboard so much. As we go through and do more education on this, you'll see why the volatility dashboard can be so informative, and it can really help you pick out strikes that are aligned with your price forecast that are going to potentially take advantage of what the market is offering you, let's say, in terms of implied volatility. Okay, so let's again. So I know I've mentioned this a few times, but I want to make sure that we actually actually really nail it here. So in this example, we're looking at QQQ, NASDAQ 100 ETF, and what we're doing here, this is from the Unusual Whales Option Profit Calculator, which is actually a really nice. This lends nicely to that horizontal spread idea because you're going horizontal instead of vertical here. But what What I'm proposing in this example here is selling the 476 put for this upcoming Friday, the 27th, and buying the 476 QQQ put for this upcoming Monday. Okay, so this is kind of unique because QQQ has option expiries every day, at least for the upcoming weeks. And then further out in time, they tend to be a few days apart or weeks apart. But short term, you can sell Friday and buy Monday. And this is something that's really unique and really valuable because weekends are interesting. Before I move on to the next slide, I want to take a moment to discuss something. Like your market maker counterparty faces a little bit of a dilemma when it comes to weekends because things can happen, right? All kinds of events can occur over a weekend, but the market won't be open during that time. So time is elapsing, and market maker models for volatility and prices are aware that weekends exist, but there's just no trading during that time. So they need to weigh Friday contracts versus Monday contracts in the best way that they can to take advantage of the impending weekend, right? This period of time when the market is closed, but things can still happen. And so when you're dealing with like a single name equity, Apple, Microsoft, Tesla, Nvidia, the like, in those names, you're unfortunately you're not able to sell Friday and buy Monday, right? You're going to sell a certain Friday and then you're going to buy the Friday before then. But QQQ, IWM, SPY, SPX, XSP, the other index, like RUT and NDX and the smaller variations of those, you potentially can take advantage of a really short dated like Friday, Monday, for example. And that's what I chose to do here in this example. The most important takeaway, though, for a calendar spread and what makes a calendar spread is that you've got two different expirations, but the same strike price. If you pick two different expirations and a different strike price, then we technically call that a diagonal. And I'm sure at some point we'll talk about diagonals and all the wonderful possibilities that exist there. But for right now, we're sticking to calendars, and a calendar means that you're always selling and buying the same contract strike price on both expiration on both expirations. Okay, so here are the stats on this particular put calendar spread that existed when I was building it in the option profit calculator. Okay, and I made sure to choose these specifically because these characteristics are very common for a put calendar spread, and I would expect like these net positions to be accurate for all calendar variations using puts. To start, the put calendar spread that we're talking about here is going to go on your book as a net debit. So you're gonna pay a debit to enter this trade. The particular contract that we were looking at, which I think was 476, if memory serves me correctly, resulted in a net debit of 46 cents. So the contract you were buying was priced at 96 cents, and the contract you were selling, that front contract, was priced at 50 cents. And so you would say, you paid a debit of 46 cents to get the trade on. Now, net delta is negative, and that makes sense because this is we're using puts and we're out of the money, right? We're using this to speculate on a downward direction in QQQ. And so what that means, don't be confused, because I know we're talking about puts, and as I was putting this slide together, I was thinking I really am going to try super hard to not be confusing. So we're long puts, and so the long put that you buy has negative deltas. Okay, so that's the one that this when I put this trade together, it had negative 0.171 deltas, so 17 deltas, and the put that we were selling, right? So when you sell a put, you get positive deltas back, had 0.124 deltas. So we are net long minus 0.047 deltas. And that means that this structure, which is of course going to change over time, but this structure is going to profit if QQQ price goes down. We're net long delta, and our delta happens to be negative because this is a put calendar spread. Moving right along, okay. So initially, when this trade goes on, the theta values that I got from this quote led to it being net positive in theta, okay, and typically you have net positive theta when you are like selling a credit spread or you're shorting option contracts and you're having time and volatility decay work in your favor. Technically, when this trade goes on, it has positive theta. Now, that some if you're a real Greek aficionado but you're unfamiliar with calendars, that might seem kind of surprising because everything else I'm describing like resembles a long put, and this would, in theory, if it stayed this way throughout the duration of the trade, this would really be the best of both worlds, right? It's like you're getting free, like decay is working in your favor, and you get the convexity where you can like pay a small debit and have the outcome pay off in multiples, rather than like taking in a credit and the best it can do is just have the credit, like, have the position go to zero, and you keep the credit that you receive.
So as like a tiny little Greeks primer, theta is positive only on structures with shorted contracts, or can theta be positive on a long contract?
So if you buy a call or you buy a put, the theta on that contract is going to be negative.
Mm-hmm.
And if, ceteris paribus, if the price of the underlying doesn't change and you continue to hold that contract, right? Like theta is the rate at which the value of that contract is, evaporating day by day.
Right.
Yeah. Now, if you were selling, now if you like sold a put or sold a call, you would have positive theta. And again, ceteris paribus, the underlying price doesn't change. That theta is the value of the contract decaying over time. But as a seller, you were
That's
like,
profit.
yeah, right on. Yeah, hell yeah, right. Like that's how you're making some money right there, right? That's a good thing for an option seller. So a few slides ago, I described this type of calendar spread as being convex. And what I mean by convex is that it's long gamma. So like gamma's working in your favor. The value of this calendar spread can ramp up really aggressively, right? Like
Right.
this 46, the $46 you outlay to buy one of these put calendars could easily go to like $1.50 or $2, something like that. I would need to review the PnL graph exactly, but it could easily go and make multiples on what the debit paid was. But again, that's why calendars are like really cool, right? And again, we'll get into all this. I know it's going to be like a real odyssey that we go on together to talk about calendar spreads. But when you start out, because you're selling a shorter dated contract, the theta on that is going to be positive, and the theta on the back contract is going to be negative. And because I chose this like this Friday Monday arrangement with QQQ.
Mhm.
Immediately at the start, the 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 positive theta from the contract that you're selling is greater than the negative theta associated with the back contract that you're buying. So like the instant you put this trade on, it has positive theta. Now, again, that's going to change. That's going to change as this like trade evolves over time.
Right.
And that's why I said calendars are harder to manage than everything else because things are evolving over time, right? And you're trying to take advantage of that, but it is a little bit more tricky to manage these over time. But at inception, this this put calendar will have positive theta. And as a little sneak peek into what happens longer term, if this trade moves in your direction, that theta is actually going to get more it's going to get more positive to a point, and then eventually it'll flip and be worse. But the theta profile on a calendar spread will get more and more positive as the underlying price approaches the strike price that you
Gotcha.
selected. Yeah. So it could be positive. And that's like really cool. If you are Houdini and you like get direction just right, like you get your timing is great and you slap on a long put calendar like this at the top of a move, and price is moving in your direction through the duration of the trade, it's going to like keep that positive theta profile because the front contract is decaying faster than the back contract, right? Like
Right.
the front one has to. It expires sooner than the back one, and so it's gonna decay faster. Great question. Feel free to keep chiming in. I know because they're unique, right? This
For
is
sure.
yeah. Okay. And then finally, the net vega on this position. So the contract that you buy, that back leg has a vega of 0.145, and the contract that you sell has a negative vega because you're selling that contract, and it has so that contributes minus 0.074 vegas. So you wind up net long vega 0.071. Now, the actual vega value doesn't matter that much, right? Like I don't look for a particular vega. I can't in my mind just like instantly think about what the implications of that is going to be. But the key takeaway here is that this structure is net long vega. So when your structure is net long vega, that means it will increase in value if implied volatility increases um, in value as well. And that's really important, and that makes calendar spreads potentially a very valuable kind of arrow to add to your quiver, especially if you're like a theta gang type, if you are a credit like a credit spread kind of trader, or a like a put, predominantly a put seller. If you tend to be net short options, then you have then your overall portfolio, your option book is going to be net short vega, and people who are net short vega had a very bad day on Monday, August 5th, when the VIX really mooned, um, because implied volatility was increasing very drastically, and they're net short vega, which means they're on the wrong side of that move, and that can be very detrimental to your PnL. And so a put calendar in this example can be the antidote to that, because you are net long vega, and if implied volatility is increasing, then the value of this calendar spread, like both the legs together, is going to increase. And again, that's because the back leg, the longer dated contract, has more has like a larger quantity of vega than the front contract that you're selling. Okay. All right. So this slide right here, I had to record. I had to record and kind of display the P&L of this trade over time, and so I've got it going on a loop. So here's the kind of the takeaway right here. When you see the P&L of a calendar spread and it has this like giant pointy top right there, you gotta be a little skeptical of that, right? If you are watching the screen along with me, you can see that for like most of the time, up until only maybe the very last few minutes before expiration, the P&L on this trade is like a much smoother, like a much smoother like kind of curve, right? It doesn't instantly turn into that big awesome TP point that you get right at the very expiration of this trade. So if you slap on a put calendar like this at this 476 put calendar, like we have right here, and then all of a sudden QQQ just teleports down to 476. I don't know, some news event or something happens, and it moves the Nasdaq, the top 100 companies in the Nasdaq. It moves their that net price down to 476 very fast, like before the front contract is expiring. The P&L that shows up in your broker is going to be closer to this like smooth level, right? It'll be up 200% or 250%, not 500 and something percent right away, right? That huge pointed P&L payoff doesn't come until the very, very last few moments when the short contract is nearing expiration. And of course, like a butterfly, the maximum profit point on this trade is if the underlying price is dead on the strike price that you selected at expiration. That's when you achieve this like maximum point. But in general, especially for something like QQQ or underlying, something with an underlying equity associated with it as compared to SPX or some other index product that's cash settled, you probably just tactically wouldn't want to hold on to it unless you want to get assigned and you want to take those shares, right? So chances are you'll be closing this position before you reach that Valhalla tip of the mountain right there. Before we kind of call it a day, or before we open it up to questions, so what I want to point out here is a couple things. All right, so when I put this structure together, the long put had implied volatility percentage. It was showing 17.2% implied volatility, and the short put was showing 22% implied volatility. So we're selling that high, we're selling the 22, and we're buying the 17.2, right? So we're like kind of locking in that differential, that 4.8 vol point difference between the two, and that's one of the reasons that these trades can be so interesting and so lucrative, because we're selling high implied volatility and buying low implied volatility right out of the gate. And then what I want to put on here, the table. Okay, great. So the option profit calculator here, what I have this showing is gross value. And maybe you recall, maybe not, but when I assembled this, I assumed you had to sell at the bid and buy at the ask. And so that means that the purchase debit on this trade would be $46, right? So like I said, if all of a sudden, like price was just to instantly, if price just instantly teleported down, what is that? For like 476 right here. The gross value on this thing that you paid $46 for would only be up like 50%. But you can see over time, as this is evolving, if price starts to hover and hang around here at your short and your short and long strike, because you're selling the one and buying the other, then the value on this keeps getting greater and greater. Okay. So right when you put the trade, like if your forecast, right, if your model tells you that price is gonna move on QQQ in this example, but it's gonna move like instantly, then calendar is not a good way to express that idea. But if your forecast says, it's I am forecasting that it's going to take a little more time to get down there, well, then all of a sudden this risk that you're taking to the reward you might see can be pretty great, right? You can very easily start to see 2 or 3 times, like 2 or 3x multiple on your debit paid out if price is drifting in the direction of the strike price that your calendar is situated on, which in this case is 476. And so you can see, at the end, at the very very end expiration right here, the calculator shows that this price could get up to $475, which would be like a 10 like a 10x. It's very unlikely, right? It's like hitting a bullseye on a bullseye on a bullseye. Not only did you predict the price exactly right, but you also predicted it for the exact moment at expiration. And again, with QQQ, you don't want to take the chance, assuming you don't want to take ownership of 100 shares because you're short that front put, and you could potentially be assigned on something like that. So don't expect this to get all the way up, to that like maximum profit level, but be aware that you could do a really nice multiple if the underlying price kind of like cruises into that area.
And so I imagine next week we'll hit the real nitty gritty in there, because I know calendar spreads. There, we definitely touched the surface, but my understanding is there's quite a bit more that can go on and happen there.
Like a duck on a lake, right? Placid and tranquil above the water, but furiously moving its feet. Under the surface, there's lots of interesting stuff happening.